That's working. All right. Huh? Oh, yeah. Hey, this is going to work out. Pause that here for a second. How we doing today, everybody? Welcome, welcome. Happy New Year, by the way. Hope you're having a good year out there. All is good. Everybody treated you well. You were safe, most importantly. A lot of times we get some time off and, man, we get into some trouble out there, huh? We are financial advisors here at Jazz Wealth, and we is just me today. It is only me, so hopefully this goes well. Seems like it's going all right. I got a chair today, you know, so let's start the new year off with the sitting for a little bit. So hope all is well. We're going to go through this here today, and welcome for the 2023 gotta be better than 2022 year, huh? By the way, it's officially the 1-year anniversary since the market high. Did you know that? Last year, the market's top was actually right on the very first day of the year. We set a ton of records, since then, not good ones, but, we set a ton of records out there, and I'll go over a few of them, but I hope to teach you a little bit here today as well, give you a little inside scoop as to how things are going without being, those typical, like, stock pick type people out there. Last year, I was doing a little research to see how things went. 7 of 12 of the months, by the way, lost 2.5% or more. 7 of 12 lost more than 2.5%. 5 of those were over 5%. So that's not normal, right? So in a typical year, you're just not going to experience that. In fact, 1931 and 1937 were the only years, which I don't think any of us were a part of, at least in an investing way. Those were the only other years that had 7 months where we lost 2.5% or more. So that's kind of a record in itself. It tied for 1931 and 1937. So yeah, I don't know how much worse 2023 can get. Let's hope we didn't just jinx it there. The S&P, if you were around on Friday, the S&P hovered right around that being down 20% year to date. So it was like right there. Was it going to close down over 20% or not quite as much as 20%? And that's where support found itself, right? All the way up until the last hour of the day, actually. We actually came in at 19.4% loss on the year. And you can just go back a little bit. That's the biggest drop since 2008 when we fell 38%. So thankfully it wasn't that bad there. Now I did a class on distributions. And maybe our clients can attest to this and point you in the right direction. If you're not a client, maybe that helps you want to become one, but yeah, it's what it is. We did a class on how often the stock market actually returns the 7% that we're used to expecting. Did you know that it barely ever happens? It's less than 7% of the time the stock market returns 7% in a year. And so I made the case in this class like we're supposed to expect an average of 7%. And yeah, it's an average, but we almost never see 7%. Well, I'm going to share a little less detailed way to look at this here, and we'll stay with this for a second. I had to, Cody's not feeling well today, so we sent him home early so none of us get sick either. So it's just me here hanging out with you today. Now's the time to get away with whatever you want in the chat. He won't be watching. But here we go. So what we did is we put together a chart that shows the performance of the stock market in the year after a specific return. So I'm going to start right here, just so you can see. If the market is between flat and up 10%, that's happened 15 times in its history, your average return the next year is anything but average. It's 3%. Well, we didn't have that this year. And now you can kind of see if you go any gains of over 10%, 23 times that happened, the average return after a double-digit year is in fact double digits, 11.8%. What I find fascinating is in any year, now granted there's only 3 of them down here, but in any year where the stock market gained over 40%, the next year you didn't want to miss out on either. Pretty impressive. Here's the bad news. Where do we land on this chart in reference to what happened last year? Well, we didn't fall 20%. We fell 19.4%. And so that will be the 13th time that that's happened where we've lost between 10 and 19.99%. And the average gain for the next year, that's not a typo. The average gain is, in fact, exactly 0. That's it. So that's what's to be expected. Think about what happens. Most of the time when the stock market has a double-digit year, but not quite 20%, it's a end of cycle pullback. So why would the market wake up and just tear off in the next year? I mean, that makes sense. So where are we now? We're in an end of cycle pullback. We've had these magnificent years, just up, 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 up. 2018 was flat, but then up, 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 up. And we made it through COVID and all this great stuff. Trade wars and flash crashes and everything that's happened since the financial crisis. But now we find ourselves with an end of market or end of cycle pullback. So ask yourself, why should this year just be a miraculous year that tears off and goes to highs again? It'd be statistically abnormal. Now you know that. But of course, it doesn't make any sense, right? It's an end of a cycle. We should be chopping around. We should be pulling back and having these large swings in volatility. Excuse me. One other thing I want to add to that is, you remember the econ chart that I shared with you a while back where I said, excuse me, I'm not getting sick. I shared the econ chart where we said, okay, all these economic indicators are a real pain to look at, right? One by one, you got manufacturing numbers and inflation numbers and housing starts and permits and all this stuff. It's a little difficult to follow all of them. Well, there's 36 of them in particular, and I made a chart to say, what if we just chart all of them in one chart and we show the number of them going up versus going down, the number of them going down versus going up? And so I actually shared this with you guys just a couple weeks ago. Every econ number, so in other words, like this 34, it would say that 34 of the 36 economic indicators are moving higher. Well, that's pretty positive, right? Maybe the sign of a top. I don't know. If you're a contrarian, you might think that. But otherwise, hey, we're headed in the right direction as far as the economy goes. Well, when I shared it with you, it was at 23, meaning negative 23. There were 23 economic indicators moving to the downside. In other words, showing nastiness, right? We're at 30 now. To give you an update, I didn't make a new chart, but we're at 30. Remember, there's only 36 of them. And look back to the left here. Anytime we have such an extreme number of economic indicators moving lower, was the economy moving into a recession or was it moving away from a recession? The gray lines shaded in the background being recessions. At no point were the economic indicators pointing lower. This is for all your conspiracy theorists out there. At no point was the economic trend, we'll call it here, moving lower, and the economy was moving out of a recession, at least to the tune that it is right now anyways. In every case, we were moving into a recession. And so almost everybody and their mother thinks there's a recession this year. Some think we're already into it. But remember, the Fed's not going to stop until they get what they want, which is what? Only lower inflation. They don't really care about anything else. So that's what you get. And so you have a recipe for the stock market that's like, okay, I don't know how to start the year. Yay, new year. Okay, well, that's a man-made event, right? We chose to have that the day of the year start now. So there's no reason for the market to just tear off and go crazy. And that's what you saw today. People saying, okay, more of the same, just a different year. Okay, there you go. Add to that the first day of the year today, historically is the most volatile. We have the widest range. We whip around back and forth more often than not. And you saw that with a lot of stocks here today. So pretty cool. Now, as far as the markets go here today, we actually started kind of optimistic. I'll go over to the S&P here. We started up higher overnight. We opened up over 1% positive. Then we were down 0.5% negative. Then we're up 1%. And that explains the first day of January being the most volatile there. Every time we moved higher, there was some news event that pushed us back down if you follow the futures market. We had IMF comments. The International Monetary Fund said, in 2023, at a minimum, one third of the world's global economies will be in a recession. Okay. Well, that probably means the U.S. as well. So that pushed us back down. Then we started working our way back up. Then China got tough saying, we're going to retaliate against any countries that say our people can't travel to your country without being quarantined. Okay, that pushed us back down. Russia picks up its war efforts over there. Okay, well, that pushed us back down. North Korea orders a massive expansion of their nuclear capabilities, I guess you would say, like their arsenal, their stockpile. Well, that pushed us back down. And so we just couldn't get anything done. So when you look at the S&P here today, there was really nothing to say we can just work our way out of this and get going. Apple, also being one of the bigger stocks, was one to make new lows here today. We'll cover that in a second. Looking around over at Tesla, we'll come back to that. Anything oil related, energy related, all weak on the day, coming off of last year's really, really good gains there. And so what does that leave you for this year? Like, what do you do? Where's the dough, man? Where are you going to find any returns if you're looking? I made a few notes on this. For the stock pickers out there, you guys are very likely going to do well if you're looking in the energy space and technology, and particular software, because there's a thing going on right now where software companies can very quickly show profitability if they want. And so they're doing that. And so that's probably where you see the greatest potential for stock pickers there, meaning you're going to play the ebbs and flows of the market throughout the year. I would say the same for energy. Energy, that sector has proven that they're focused on returning cash to shareholders and slowly starting new projects. That'll take some time, but when they're returning cash to shareholders, what does that mean in a soft economy? You've seen the chart, you've watched the show, you know stock traders or investors, they reward that. And so you likely see higher prices. Investors, where do you look? You say, I'm not a stock picker, man. Where do I go? What do I do this year? Well, remember there's something called the Inflation Reduction Act, which has nothing to do with inflation. Well, every analyst and their mother have analyzed this, and not one analyst has said that there will be less than a 50% increase in the total upside of their stock's earnings, the stocks that benefit from that. So if you're an investor, you go, all right, Inflation Reduction Act, what's that all about? What stocks will benefit the most from this sort of big government helicopter just dropping money on these companies to go out there and do the green energy thing, even though it's called Inflation Reduction Act? Who's going to benefit from that? It's time to start looking through that. I'm actually going to put together a list. I'll put it on our research site so it's in detail for you to let you know who stands to benefit directly, who's going to get the most amount of money from that. It is almost done. And if you want to join on the research site, it's free for clients, but if you want to join, and you can't join us here at Jazz, you have jazzwealth.com/research if you're interested in joining there. If not, no big deal, no big deal. It's all good. All right, today in the markets here, we had one new high. I actually thought it was going to be our best performer in our portfolios here today, but it was not, actually. It's up 28% for the quarter. That is Las Vegas Sands, and this is all thanks to China. It should be called China Sands, Macau Sands. It should be called something else here. And a fun metric that I stumbled across through Goldman Sachs, this is not my data. If you look at Las Vegas Sands' revenues, their revenues grow at 1 to 2 times Chinese GDP like clockwork. And I didn't take their chart. I could have, I guess. But you look at a chart and you see China GDP, you look at their revenues there, it's between 1% and 2% growth. So that's the metric everybody likes to follow there, apparently, and that's going really well. This rally over the last couple months is all due to the reopening in China, by the way. And one way to look at that and kind of confirm it is just look at any other China stock there, right? Some of these really low, like beaten down ones. I should use Baidu as an example. Look at the last couple months. I should use Alibaba as an example. There you go. It's trying to do its thing. In fact, if you look over the performance around the world, and just since markets reopen and everything, you look over that, you're actually going to find, and I can't pull it up at the moment. Where did it go? I had it saved here somewhere. China, best performer, right? Overseas, every Chinese stock, super, super strong. And obviously, that's good news for them. Get things back and going there. So that's the kind of results you're seeing over there. 4 new lows today, by the way. I want to point out a couple of the REITs. Wow. All right, let's do that. You got REITs, Public Storage here making a new low. You're probably familiar with them. Storage units, that's what they do. It's a fresh breakdown, down 20% over the last year. Extra Storage Space is in the same camp. EXR is the ticker symbol, real sharp and steepening downtrend there. This is more of a, how do you say it? It's more of a higher yielding, higher margin business than Public Storage, if you're interested in that, or you're looking over there and putting together a little list. Let's talk about the things that everybody's looking at here today. Tesla. There you go. So Tesla deliveries come in a little bit worse than expected there. 405,000, that was below everybody's expectations. And that continues to be, is Elon Musk too focused on Twitter or whatever it is? Well, interestingly enough, they changed their second in command. And it's actually a guy that was responsible for getting the Shanghai plant up and running there. So it is presumed or, assumed is starting to raise up his second in command there. So I thought that'd be good news, but of course you're missing deliveries, and Wall Street had a number that was considerably higher than that, and that's not going to work out well for them. You may have noticed Molina Healthcare, one of the bigger movers here today. If you look over at them, they were talking about their new contracts that they have in California, and was saying, okay, that's going to double our revenue. However, they then changed their statement ever so slightly and said, oh, sorry, we meant double our revenue in the state, right? Not double our revenue in the state. And people were like, oh, all right, well, that's not much then. Other news here, you got Shopify, a little bit higher there, changing their algorithm a little bit to help with some better and more targeted advertising there. So good news for them. Hopefully that'll get them going, because they've been really beaten down there for a lot. Also, Coke and Pepsi. Bill Ackman sent out a tweet real early today, saying that these guys have caused more global health problems than any other company on the planet, both Coke and Pepsi. So, gee, what position he may have? You think he owns the stock, or is he maybe short the stock? I don't know. I guess we'll have to see. What else do we have here? Hey, Jazz After Dark. We've been covering a lot of cool topics here lately. We talked about short-term, long-term tax loss harvesting, not so important anymore. We talked about who gets Social Security when you die, and how does that work depending on if you're married or widowed or whatever it is. We also, tonight we'll be covering the 4 must-haves for your 2023 financial plan there, right? So we'll be covering that, and I know that maybe just blipped out for just a second. I'll give it a second to come back, because little hiccup there. Not quite ready to start out the new year, apparently. So it's hiccuping a little bit. But yeah, tonight we'll cover 4 must-haves for your 2023 financial plan, and we'll hope that that works. That works for you there. Come hang out with me, have a drink, and let's do some things, learn some stuff. Also, on Thursday, CES, the Consumer Electronics Show, starts, and Thursday it's a bit of a market mover, right? So just know that, right? There's a lot of data that shows semiconductors and all these other things doing really well during that time. So we'll cover that a little bit more in detail as we get closer to it. Yeah. Is this working right? What's going on, man? What's going on over here? I think everything's good now. Let's see if I can answer your questions. Otherwise, we'll get to it and get on out of it. You got more? Oh, and so that answers the question, by the way. We were talking earlier in the class here. Will the stock market be moving higher? Yeah, I guess something's going on there. We'll let it catch up for a second. Yeah, it's catching up. All is good now. I got the green signal here, so we'll just let it catch up. And give it a second to do that thing. Didn't want to come back to work, huh? Didn't feel like coming back to work today. That happens. All right, I think we're good now. That should be better. We got lots of data coming in. We're looking right. You think China has bottomed? I think there's a good case to be made for that. I mean, they're being more, after the riots and everything, they're being a little bit more loose on their people getting back to work. Interestingly, a lot of people over there are intimidated to go back to work. It's not just as easy for them to just get up and go to work like we did. I don't know what's happening over there, but I thought that was kind of interesting. Yep. You like the Canadian banks? I don't know why. Don't know why in particular. You like the Canadian banks there, but you don't like the U.S. banks or some of the Chinese financial companies that are out there? Giovanni bought some fuel cell for or plug for clean energy. Those are tough ones. Yeah, those are tough ones. I mean, I know, what was it? Biden said something over the weekend about their progress and how they want to essentially, make that a government-run thing. I don't know why that is, but I'd have a hard time with those. I'd be more interested in companies that, have a little more established, right? A little bit moving along. I wouldn't be excited about it. I don't have anything good to say, essentially. That's why I'm sort of speechless there. You should buy the Mega Millions or the Powerball. I don't know. I think if you want to be more famous, buy the Powerball. Tend to get a little more media attention there. Ashish, I saw your email there. Have not forgotten about you. Just catching up after the long weekend there. Yeah. I don't know. Remember, there's a lot changing this year. So we're covering a little bit of it tonight and tomorrow night in our Jazz After Dark, but we have the Inflation Reduction Act taking effect. Remember, 2023 is when that takes effect. So there's a lot of changes in terms of buybacks, a lot of changes in terms of how that money is going to be spent and where. Lots of money. And then we also have what I see a lot of people calling it the Secure Act 2.0. Okay, yeah, whatever. It was in the spending bill. And when you break out just the retirement stuff, I touched on it a little bit, but a lot of changes there, but not what there could have been. Seems like a lot of just little things like you give to your kid just to get them to be quiet or something, but that's a tough one. But we'll cover those. Should we front load our IRAs this year? Yeah, you always want to, well, let's say it this way. The maxing out your IRA or Roth IRA at the beginning of the year always beats dollar cost averaging throughout the year. Just any study. You can look it up online and see all the details there. Next best thing was the weekly deposits. We did a class for clients to go over, how all that works and everything. But you'll always beat that. Now, this year, I'd be a little more interested because I know I just got that discount. It's like, okay, we're already moving lower here. I'm going to fill this thing up anyways. Yeah, it's a lot better than doing it this time last year. If you did it on the first day of January last year, you picked the top. That was the absolute top. So remember thank you, Financial Wisdom. The number is higher. So you got 6,500 and 7,500 just in the IRAs and Roth IRAs. But yeah, that's what I would do. Yeah. Oh, yeah. And that's why. Yeah, now you know. You think the question of front-loading your IRA was more to do with you overturning the max? Not sure what you mean there, but you are welcome. He picked January last year? Yeah. Well, it sucks either way. Even if you pick the first couple weeks in January, right? Like, it happens that the first day was the high, but it's like, oh, man, if I had to pick the first one, first couple weeks, you'd still be mad. We still have that cash, by the way. So in November of last year, we finished, not last year, in November of 2 years ago now, we had finished slowly selling off to raise some cash, and we still have pretty much all of it there. So I'm interested in buying pullbacks as well. Oh, yeah. That was, I don't want to say lucky because obviously you make your own luck and all of that, but that was very helpful to not be 100% invested last year. Very helpful, and I'm not upset about that at all. So let's get some opportunities, man. Let's get this market to pull back. I'll be happy to play along with it. And we will also be here tomorrow. We'll be back tomorrow. I'll see how Cody's feeling, maybe get back to the regular show, how we do things. But other than that, I'm going to wrap it up here. You guys enjoy the rest of your evening. And we'll see you later, right? Jazz After Dark, coming to hang out with me? All right. I don't know, how do you end this thing? Probably